Let's start with something simple. You're human. That means you want things. Basic things like food and shelter, and not so basic things like a nicer phone than your friends, a bigger TV than your cousins, or a coffee that costs more than it should but makes you feel successful. Here's the problem. There isn't enough of everything for everyone. There aren't infinite houses, there isn't unlimited food, and there are definitely not enough slightly larger TVs to satisfy human jealousy. This problem has a name. It's called scarcity. Scarcity is the reason you can't have everything you want. It's the reason societies need rules, systems, and choices. And it's the reason economics exists at all. If resources were unlimited, if pizza magically appeared whenever you wanted, there would be no economics. No prices, no choices, no stress, just pizza. Forever. But that's not the world we live in. Because resources are limited, we're forced to decide who gets what, how much do they get, and what do we give up to get it. That's economics. Choices and trade. Why we exchange stuff. Because we can't have everything, we make choices. And because we don't all have the same things, we trade. Imagine this. You have apples. I have bananas. You don't want only apples. I don't want only bananas. So we trade. Now you have variety. I have variety. Everyone wins. Unless you're allergic. In that case, you still win. Just with medical assistance. Trade happens because it makes people better off. But trade also introduces an important idea. Opportunity cost. Every time you choose one thing, you give up another. Watching this video means you're not watching something else. That thing you didn't do? That's the opportunity cost. There is no such thing as a free choice. Every decision has a cost, even doing nothing. Why specialization works, even if you're bad at everything. Now here's something interesting. You don't have to be good at something to benefit from trade. You just have to be less bad at it than at something else. This idea is called comparative advantage. Even if you're worse than everyone else at everything, you can still specialize in the thing you're least terrible at and trade for the rest. That means everyone, yes, even you, is economically useful. Trade isn't about being the best. It's about being efficient relative to your alternatives. Congratulations, you matter to the economy. From trade to markets, put scarcity, choice, trade, opportunity cost, and comparative advantage together. Shake them. Boom. You've just created a market. A market is any place where buyers and sellers interact to exchange goods or services. It can be, and what do we give up to get it? That's economics. A farmer's market, a stock exchange, an app, or your cousin selling you digital items through PayPal. What makes markets work isn't kindness or fairness. It's incentives. People respond to incentives. If something is expensive, people buy less of it. If it's cheap, people buy more. Prices guide behavior. This creates supply and demand. Demand. How much people want something at different prices. Supply. How much producers are willing to make at those prices. Where supply and demand meet, you get the equilibrium price. The price where buyers and sellers agree. Markets constantly adjust through prices. When governments try to ignore this reality through price controls, things usually get weird. Or bad, or both. Why money exists, and why it's weird. Bartering has limits. Trading goats for Wi-Fi is inefficient. So humans invented money. Money isn't special because it's paper or digital. It's special because people believe in it. Money does three things. It's a medium of exchange. It's a unit of account. It's a store of value. In short, money keeps trade smooth. Think of it as economic lubrication, banks, loans, and how money is actually created. Banks don't just store money, they create it. When a bank gives you a loan, it doesn't hand you someone else's cash. It creates new money digitally. This system is called fractional reserve banking. It works until everyone panics and wants their money at once. That's a bank run. Deposit insurance exists to prevent panic and keep the system stable. Productivity. The real source of wealth. Why are some countries rich and others poor? The answer isn't effort. It's productivity. Productivity means producing more output with the same input. If a country can produce more goods per worker per hour, living standards rise. Productivity depends on technology, education, infrastructure, institutions. It's the single most important factor in long-term economic growth. GDP, measuring an economy imperfectly. To measure economic activity, we use GDP, gross domestic product. GDP is the total value of all final goods and services produced in a country in 1 year. It can be measured 3 ways. Production income expenditure. The expenditure formula is GDP bar C plus I plus G plus X M. GDP is useful, but flawed. It doesn't measure happiness. It ignores unpaid work. It doesn't care what is being produced. Still, it gives a rough idea of economic size and growth. This idea is called comparative advantage. Even if you're worse than everyone else at everything, you can still specialize in the thing you're least terrible at and trade for the rest. That means everyone, yes, even you, is economically useful. Trade isn't about being the best. It's about being efficient relative to your alternatives. Congratulations, you matter to the economy. From trade to markets, put scarcity, choice, trade, opportunity cost, and comparative advantage together. Shake them. Boom. You've just created a market. A market is any place where buyers and sellers interact to exchange goods or services. It can be, and what do we give up to get it? That's economics. Booms, busts, and inflation. Economies move in cycles. Growth, more boom decline. More recession, severe decline. More depression. Inflation happens when prices rise across the economy. It can be caused by too much demand, too little supply, too much money. Hyperinflation destroys trust in money entirely. Central banks and monetary policy. Central banks control money supply. Interest rates. High interest rates slow the economy. Low rates stimulate it. Tools include rate changes, open market operations, quantitative easing. They aim to balance growth and inflation. Taxes, government, and debt governments fund spending through taxes. Types include income tax, sales tax, property tax, corporate tax, capital gains tax. If spending exceeds taxes, governments borrow. That creates national debt. Debt can be useful or dangerous, depending on how it's used. International trade and globalization. Countries specialize and trade based on comparative advantage. Trade increases efficiency, but creates winners and losers. Governments sometimes intervene with tariffs, quotas, subsidies. Globalization connects economies, but also makes them fragile. Currencies and exchange rates. Currencies trade in foreign exchange markets. Exchange rates affect exports, imports, inflation. Currency crashes make foreign debt harder to repay. Labor markets and wages. Jobs are markets too. Wages depend on skills, productivity, bargaining power. Unemployment comes in many forms. Frictional, structural. Cyclical minimum wage policies help or hurt depending on design. Finance, investing, and risk. Financial markets connect savers and borrowers. Assets include stocks, bonds, derivatives. Crypto risk and return are linked. Diversification reduces danger. This idea is called comparative advantage. Even if you're worse than everyone else at everything, you can still specialize in the thing you're least terrible at and trade for the rest. That means everyone, yes, even you, is economically useful. Trade isn't about being the best. It's about being efficient relative to your alternatives. Congratulations, you matter to the economy. From trade to markets, put scarcity, choice, trade, opportunity cost, and comparative advantage together. Shake them. Boom. You've just created a market. A market is any place where buyers and sellers interact to exchange goods or services. It can be, and what do we give up to get it? That's economics. Development. Why some countries stay poor. Poverty traps exist. Growth requires education institutions, stability, infrastructure. Foreign aid helps sometimes, but isn't magic. Behavioral economics. Humans are not rational people. Fear losses, love instant rewards, follow crowds, fall for sunk costs. That's why nudges exist. Economic systems. Every system answers 3 questions. What to produce, how to produce, who gets it. Capitalism, socialism, and mixed economies all involve trade-offs. No system is perfect. Final thought. Economics isn't about money. It's about choices, trade-offs, incentives, and human behavior. Scarcity is real. Choices have costs. Markets coordinate action. And nobody agrees on the best system. And that, believe it or not, is economics.